Good afternoon to all of you. Today we will learn the last part of the ratio analysis, that is solvency. Because in my previous lecture we have discussed the turnover part, profitability part, that is we have already discussed the complete overall profitability, that is ROI of an organization. In solvency, I have also already discussed the liquidity position of an organization by taking into consideration current ratio, liquid ratio, quick ratio. Now the last part, which today we want to complete, that is solvency position of the organization. As you know well, that solvency means, and solvency we consider at the time of the winding up of an organization. That is when the organization is going to shut down. At that moment of time, if the organization is capable enough to pay all the long-term fund, that is capital and long-term liabilities as well as short-term liabilities also, then we can say the organization is solvent in nature. It means the organization is capable enough. But reverse to this, if the organization's assets are lesser than the amount which you want to pay to the long-term investors of an organization, that is to the equity shareholders, preference shareholders, debentures, bank, then we can say that organization is insolvent, or we can say the organization become bankrupt. Now, to know whether the organization is solvent or not, we would like to calculate few ratios which comes within the solvency of an organization. In this, the first ratio which we want to consider, that is called debt ratio. Solvency means long term. Solvency means to pay all long-term funds from the assets which the organization have to pay back these long-term fund the organization have to sell all fixed assets into cash. So, if the organization is sufficient to have cash after converting the fixed assets into cash, then we can say, and that is sufficient enough to repay back all the long-term fund, then we can say the organization is solvent in nature. For this, the first ratio which we want to calculate, that is called debt ratio. Debt means what? The liabilities, that is scourge. Debt means scourge. liability. Curse. Don't misunderstood, this curse is a Hindi word. Maybe the person who is listening, watching these videos from outside India, from Saudi Arabia or Ethiopia or UK or US, which you are watching, I know, may not know the word curse. Curse means the liability which you take, which you procure from to start the business. So we want to know that how much debt you have, how much debt you have procured and invested in the total assets. If suppose the debt part is more, which you have invested in your fixed assets, then what happened? Then certainly this is less expensive in nature for keeping into considerations the organizations, less expensive because you have to pay interest at fixed rate to the debt capital holder, either to the debentures or to the bond holders or to the bank, maybe at the rate of 10% or whatever. But the most expensive capital which you procure, that is called equity share capital. Because if the amount of profit is increasing, so that profit will be shared by the equity shareholders only. So equity shareholders are the most expensive investors in the organization. So we want to know whether the proportions of debt involved in total assets is okay or not. Whether by this ratio the debt holders will feel confidence that my money is safe in the organization. So how you calculate this, how you measure this debt ratio? That is total debt. Total debt divided by total assets. Total debt means what? Total debt means long term as well as short term both. Short term debt means the debt which you have to pay within short period. That is overdraft, creditors, bills payable, if you fail to pay at the time of payment schedule, the amount of which is increasing day by day. So total debt is long term plus short term. Long term debt plus short term debt divided by total assets. So what do you think? The ratio should be less than 1 or more than 1? If this debt ratio is more than 1, it means what? It means your total debt is higher than your total assets, and in this situation you are not capable enough to repay back the total debt out of the total assets, which is liable to convert into cash at the time of winding up of an organization. It means you can say that you are bankrupt. And in this situation, the investors will not feel confidence in the organization. It means the investors that is debt holders, will not take interest to invest their capital in the organization where this debt ratio is less than, where debt ratio is more than 1. So this debt ratio should be less than 1. And in this situation only, the debt capital holder will feel confident. Okay, assets is more and our debt is less, so from at the time of winding up the organization, I will get the money back. There is no problem. Is that clear? Debt ratio, now I want to convert this into Indian language, that is in Hindi. Maybe you, in this way you can learn Hindi also, no problem. And most of you might have visited India, maybe for education purposes. Ethiopians, most of the Ethiopians to whom I taught came to India for master's degree, for PhD degree. So maybe you know thoda Hindi. So debt ratio is, that is कर्ज. हमने कितना कर्ज लगाया है व्यापार में? क्या मेरा कर्ज, वो जो जिसने कर्ज लगाया है, क्या वो अपने आप को सुरक्षित महसूस करता है? कब महसूस करेगा सुरक्षित? तब ना जब उसको देखेगा जो उस ऑर्गेनाइजेशन के पास पर्याप्त संपत्ति है, ताकि व्यापार अगर बंद होने लगेगा तो उसको उसका जो भी उसका कर्ज लगाया है, कर्ज दिया है व्यापार को, वो उसको वापस हो सके। बस इतनी बात है। और इस डेट रेशियो को 1 से कम होना जरूरी है। अगर 1 से ज्यादा हो जाएगा, इसका मतलब जिसने व्यापार को कर्ज दिया है वो अपने आप को अनसेफ समझे, वो असुरक्षित है, क्योंकि उसके पैसे वापस नहीं होंगे जब व्यापार बंद होने लगेगा, क्योंकि व्यापार के पास उतनी संपत्तियां हैं ही नहीं जो उसको वो पैसा वापस दे सके। ये एक रेशियो हो गया। दूसरा रेशियो है डेट टू इक्विटी रेशियो। डेट टू इक्विटी रेशियो बहुत आसान सा रेशियो है। ये रेशियो बहुत तरह से निकाला जा सकता है, लेकिन जनरली इस रेशियो को शॉर्ट टर्म को कंसीडर नहीं करके लॉन्ग टर्म को कंसीडर करके निकाला जाता है। जब लॉन्ग टर्म कंसीडर करेंगे तो इस टोटल डेट में जहां पर हमने शॉर्ट टर्म लिखा है, यहां शॉर्ट टर्म को हटा देंगे। सिंपल आइडिया। दैट इज लॉन्ग टर्म डेट डिवाइडेड बाय shareholders fund. Long term debt divided by shareholders fund. मतलब यहां पर हमने निकाला जो टोटल एसेट्स में लॉन्ग डेट कितने हैं, कर्ज कितने हैं लगे हुए, इसमें निकाला जो हमने पूंजी ली है उसके बीच का कितना प्रोपोर्शन है आपस में। हमने जो पूंजी लगाई है व्यापार में टोटल एसेट्स में, यहां पर ये लॉन्ग टर्म डेट है, कर्ज है, लेकिन उसको हमने कंसीडर नहीं किया जो मालिक हैं। ये तो कर्ज का हिस्सा है, लेकिन जब पूंजी ली है उसमें 2 तरह के हमारे पास स्रोत हैं। एक है जिसको मालिक के बतौर लिया है, जिसको हम शेयर कैपिटल कहते हैं या शेयर होल्डर्स फंड कहते हैं। उसमें हमने रिटेन अर्निंग को जोड़ दिया तो शेयर होल्डर्स फंड हो गया। दूसरा लॉन्ग टर्म डेट हुआ, जिसे बॉन्ड, डिवेंचर्स, लॉन्ग टर्म बैंक लोन्स आया। यहां हम और इन दोनों पैसे को पूंजी को कहां लगाया? बिजनेस में हमने इन्वेस्ट कर दिया। कहां इन्वेस्ट किया? टोटल एसेट्स में इन्वेस्ट किया। यहां हम कंसीडर कर रहे हैं जो पूंजी ली है उसमें लॉन्ग और शॉर्ट, उसमें कर्ज और मालिक ने क्या proportions है. तो इसमें proportions मतलब in this debt to equity ratio, we want to make the relationship between long-term debt and shareholders fund. Long-term debt we consider as bond. Who is issuing bond? That is public sector. Private sector will not. Like life insurance corporations. This is public sector. When you take the policy of LIC, LIC will give you the bond paper. But the private sector like Reliance or some Tata or Toyota or Maruti, if they need debt, then they are not supposed to issue bond, they are supposed to issue debenture. And from bank, that is loan. You take the loans from the bank. So the debt capital, one is the bond if you are the public sector, debentures if you are the private sector, or otherwise the loan. So we are considering all three: bond, debenture and long-term bank loan. Over shareholders fund. There is a difference between shareholders fund and share capital. I think you know that. Share capital is the combination of sum of equity share capital and preference share capital. That's all. But the moment if you consider shareholders fund, then you have to add some other fund also, and that is called the earning which you have not distributed among the shareholders, equity shareholders. Suppose you have earned 10 rupees per share, and out of 10 rupees per share you have distributed only 4 rupees to the equity shareholder. It means 6 rupees you have retained for the within the organization. Why? Because you are in need when in future. Why? For expansion. What else? For diversification. What else? For modernization. What else? For replacement. What else? For installing a pollution control equipment, which is also very expensive in nature. So all these needs fund. If we distribute all 10 rupees among the equity shareholders, then what happened? How much we have in the organization? Nothing, zero. Then is it possible to diversify, modernize or expand the market? Why not? How? We take loans from the bank. Oh, if we take the loans from the bank, then what happened? Then your interest will increase, your risk will increase. Oh, that's what? Yes. Okay, I will not take loan from the bank. Then what? We will issue shares. Is it also risky? Certainly yes. Why? If you issue more shares, the number of equity will increase. Oh, yes. It means number of brothers will increase. And if the number of brothers will increase, then what happens? Your share will decrease. Because if the number of equity shares will increase, then earning per share will decrease. What do you think? Earlier you have given one bread to an equity shareholder. Now you are giving half bread or 1/4 bread. Then what happened? Do you think that equity shareholders will retain in your business? Certainly not. They will withdraw the money from your organization and invest that money in that organization where he will get 1.5 bread. Then what happened? Your control among the investors will lose. You will lose your confidence, and the investors will not invest the money in future in your organization. So at the time of expansion, diversification, modernization, replacement, you will not get money from the financial market. Oh, so then it is very important, necessary to retain the money from the profit. Yes, and that is the reason why I told you that don't distribute all 10 rupees, distribute only 4 rupees, 6 rupees you retain. And 6 means 6 crores. And now you need 2 crores for expansion. No need to take loan from bank, no need to issue shares. Because you have already 6 crores, out of 6 you invest your 2 crores for expansion, diversification, modernization. Then your number of equity will remain same. And you will expand the market, diversify the product, your sale will increase, your profit will increase, your EPS will increase. Your investors will feel happy because right now you pay only 6, your earning per share is 10. In future, the earning per share will increase from 10 to 100 and you will pay, instead of 4, you pay out of 100, 40 rupees. See the difference. And this is the reason why we retain, whatever the amount we retain in the organization, that you are liable to invest in the organization in future. And when you add this retained earning or reserves and surplus in share capital, that will give you the detail of shareholders fund. So in shareholders fund, what you include? Equity share capital, plus preference share capital, plus retained earning, or you can say at reserves and surplus, or you can say as profit and loss account. Profit and loss account means the net profit which you transfer from PL account to balance sheet. If the organization is earning profit, the organization's capital will increase. If the organization suffers from loss, that loss will be borne by the equity shareholders, and in this way the capital of the organization will decrease. So this is when you add this retained earning, reserves and surplus, and equity share capital, reserves and surplus and PL account in share capital, that will give you the data of shareholders fund. Now, suppose you need 100 rupees. How much you need to take from long-term debt and how much you take from equity shareholders fund? The ideal ratio is 0.67. It means if you need 1 rupees, then 67 paisa. If you need 100 rupees, then you take 67 rupees from debt capital, from long-term fund. Is that clear? If the amount, you can ask me a question. What if the debt equity ratio will increase from 0.67 to 0.90? It means in 1 rupees you have invested 90 rupees, in 100 rupees you have invested 90 rupees, you have taken from debt, from long-term debt. Then your risk will increase. Then if you took 90 crores at the rate of 10% interest, then minimum 9 crores you have to earn to repay back the interest to the debt capital holder. This is risky. What if this debt equity ratio will change from 0.90 to 0.10. Then what happened? It means debt is less and shareholders fund will more. It means number of equity is increasing. It means you took more money from by issuing equity shares. This is also risky, because the moment you took loan, you have issued equity shares, the number of equity will increase and earning per share will decrease. That is also risky. So you have to follow the middle path. And middle path is how much? As normally it is 0.67, that is you take only 67% debt in your total capital, which you are going to employ in the business. If increasing, you have seen the consequences. If decreasing, then also you have seen the consequences. If increasing, debt is increasing, interest is increasing, decreasing, number of equity is increasing. Number of equity increasing, earning per share will decrease. That is difficult. Third one, that is capital gearing ratio. Capital gearing, very important ratio and very interesting also. Capital gearing. I think you must have ride your motorbike or car. In car you have seen there are 3 or 4 gears. Am I right? Yes. What happened? What if you will drive your car in first gear? What do you think? The car will move slowly, very smoothly, or very hard? Very hard. The moment you will increase the gear, the car will movement become more smoother. And at 4th gear, the movement become more smoother. Which one is better? Gear 1 or gear 4th? Obviously gear 4th. Here also the same thing will happen. Here also when the gear is high, the organization will run smoothly. When the gear will less, then obviously there will be a risk. How you measure this capital gearing ratio? This is, you relate that. How you relate? That is fixed charges bearing securities. Fixed charges bearing securities. See the difference between these 3 ratios which we have calculated. Divided by shareholders fund. Or you can say not shareholders fund, equity shareholders fund. Equity shareholders fund. Now you see here in first debt ratio. Debt ratio we have related the debt with total asset. That in total asset the proportions of debt involved. In second, we have related the total capital. In total capital we want to know that how much is your total debt, long-term fund, and how much is your shareholders equity shareholders fund. In third, we have related the fixed charges bearing securities as well as non-fixed charges bearing securities. Because in your capital there are 2 types of securities. One is for which you are paying fixed charges. One is for which you are not paying fixed charges. What is that? For this you have to go to the market first, and you have seen there are 2 types of capital. One is owner's capital and one is debt capital. In owner's capital, you have seen 2 types of capital. Equity share capital, which is known as common stock, and the other one which is preference share capital, which is known as preferred stock. In debt capital, you have seen one is bond, one is debenture, and one is long-term bank loan. And share cap owner's capital, one is equity share capital, one is preference share capital. Now you see, to the debt capital, that is bond, debentures, and long-term fund, what you pay? You pay the interest at fixed rate. Interest at fixed rate. This is fixed charges. But what about this? This is also preference share capital. Preference share capital also you are paying dividend. Dividend at fixed rate. Dividend at fixed rate. What is dividend? Dividend is part of profit. Part of the profit. In Hindi, which is known as labhans, labkans. Here, dividend is fixed rate, but what about here? Here, dividend rate of dividend is not fixed. Dividend rate is not fixed. So, there are two types of, one is fixed charges, this is also fixed charges, this is also fixed charges. This is non-fixed charges. It means this is the relationship between fixed charges and non-fixed charges. In your capital, which you procure from different organizations to run the business, you have taken two types of capital. One is for which you are going to pay fixed charges. One capital for which you are not going to pay any fixed charges. One is for which you are not going to pay any fixed charges. This is risk-free capital. Why risk-free? Because you are not liable to pay even 1 penny to the equity share capital at the time when the organization is suffering from loss. Risk-free. You are not going to pay any amount at a time of loss. But to the risky capital, to the fixed charges, in any situation you are liable to pay. Whether the organization is suffering from loss, you are earning profit. It is a mandatory for the organization to pay interest to the bond, to the debt capital holder. But in the case of loss, you are not going to pay any amount to the equity share capital. That is the reason why this is called risk-free and this is called risky. But risk, if you take into consideration the risk, this is less risky, risk-free or risky. But economic or expensive, then this is less expensive, this is economic in nature, and this is expensive in nature. Is that clear? Now, so that capital gearing ratio is what? This capital gearing ratio is the relationship between fixed charges bearing securities over the non-fixed charges bearing securities for which you are not going to pay any charge. Is that clear?
रिकॉर्डिंग अपोजिट आ रहा है, अपोजिट इधर का रिकॉर्डिंग आ रहा है.
Oh, sir. That तेरी के. मेरा सब बर्बाद हो गया, कोई बोला नहीं। और ये